So you want to own a self-storage facility. You're picturing the boring part: rows of orange doors, a padlock, some guy's old couch, a parking lot for junk. The least glamorous thing a person with money could possibly buy. And here's the number that should make you look twice. There are now more than 52,000 self-storage facilities in the United States. More than every McDonald's, Starbucks, and Subway in the country combined. Together, they hold over 2.1 billion square feet of empty air, roughly 3 times the size of Manhattan, and they pull in somewhere between $44 and $50 billion a year. All of it for storing things Americans own but can't bring themselves to look at. The couch is real. The junk is real. But the business you're actually looking at is one of the highest margin machines in American real estate, and by the time you understand why, you'll never see those orange doors the same way again. So let's walk through it. The price, the mechanism, the scandal nobody puts in the brochure, and the one thing that quietly kills the people who buy in wrong. Before going ahead, please subscribe to the channel if you are new here. We do stupid rich math for the things you want to own. You can also comment on which thing you want us to make videos for you. The price menu. Compared to almost anything else a rich person buys, the entry ticket here is almost insulting. The classic single-story facility, the drive-up rows of metal doors you picture, costs $25 to $75 per square foot to build, land included. Do the math on a modest 30,000 square foot facility with around 250 units, and you're looking at roughly $1 to $1.5 million for the whole thing. For the price of one nice apartment in Manhattan, you get 250 tiny rooms in Texas that never call you at 2 a.m. about a broken toilet because there is no toilet. Want to go upmarket? Multi-story, climate-controlled buildings in big metros run $110 to $160 per rentable square foot elevators. Insulation hallways that smell like nothing. Those charge tenants a premium. The national average for a climate-controlled unit sits around $134 a month against $119 for a plain 10 by 10. Roughly 30 to 60% of a modern facility's space is now climate-controlled, because adding air conditioning can nearly double the revenue on the same square footage. Or you skip building entirely and convert. Remember every dead Sears, Toys R Us, and Bed Bath & Beyond rotting in a parking lot near you? Turning a big box corpse into storage runs $35 to $70 a foot, about half the cost of building new, because the skeleton is already standing. The most hated buildings in American retail are quietly being reborn as some of the most profitable ones. What that means for the people buying entire dead shopping centers is its own story. Or you buy one that already exists and already runs. Most facilities trade hands somewhere between $500,000 and $3 million at capitalization rates of 5 to 7.5%, depending on quality. There are over 52,000 of them, and more than 70% are still owned by mom and pop. Operators, 1 or 2 facilities, a spouse doing the books, a business built in the 1990s and never modernized. That fragmentation is exactly why private equity is circling this industry like it smells blood, because it does. Why the math shouldn't be this good. Here's the core trick, and once you see it, you can't unsee it. A storage unit rents for roughly the same price per square foot as an apartment or an office in the same neighborhood. But it costs 35 to 40% less to build and almost nothing to maintain. Same revenue per foot, half the cost. That's the entire business model in 2 sentences. Now, stack the advantages. An apartment tenant comes with a lease, tenant rights, eviction courts, and a toilet that floods on a holiday weekend. A storage tenant comes with a padlock. No plumbing per unit, no kitchen, no heating in the basic version. And with modern keypad gates, app-based rentals, and algorithmic pricing, a facility can run on 1 part-time employee or, increasingly, none. Contact-free leasing platforms now let a single manager run several sites from a laptop. Your staff is a phone app and a gate motor. Then there's the demand, which is the genuinely strange part. The industry politely calls its 4 demand drivers the 4 Ds: death, divorce, dislocation, and downsizing. Look at that list again. Not one of those cares about the economy. People die, split up, move, and shrink their lives in booms and in recessions alike. That's why national occupancy barely flinched through the last downturn and sits around 92% for the big institutional operators today. You're not selling a product, tied to consumer confidence. You're selling shelves to catch the debris of people's lives, and the debris never stops falling. And here's the mechanism that turns a decent business into a great one. Once the stuff is in the box, it doesn't leave. Storage tenants stay for years, and they absorb annual rent increases of 6 to 10% with barely a shrug. Why? Because the alternative to paying $12 more a month is renting a truck, bribing two friends, giving up a Saturday, and then facing the real horror deciding whether you even want any of it. $12 is cheaper than that reckoning. The operator knows this. The operator has a name for it, the existing customer rate increase, and it is the single most reliable lever in the business. You're not renting people space. You are renting them the freedom to not make a decision, and indecision, it turns out, pays about 8% more every year, means forever. None of this was obvious. Somebody had to notice it, and the man who did built one of the great American fortunes on it. In 1972, a California real estate developer named B. Wayne Hughes was driving through Texas when he passed a building that was nothing but garage doors and a line of people paying rent for them. Hughes came from nothing. His family were Dust Bowl sharecroppers who'd driven out of Oklahoma with a mattress tied to the car. Back in California, he and a partner put up a cheap prototype in San Diego with a $50,000 investment. Orange doors. They hired a mariachi band for opening day. The plan was to temporarily park some sheds on the dirt, wait for the land to appreciate, then build something real. Within 3 months, the prototype was breaking even at 35% occupancy. Read that again. The building was 2/3 empty and already paying for itself. Hughes quietly cancelled something real. That company became Public Storage. Today it runs more than 3,300 facilities. And in March 2026, it announced a $10.5 billion all-stock deal to swallow National Storage Affiliates, a combined entity of roughly 4,600 facilities and 328 million square feet, with an enterprise value near $77 billion. When Hughes died in 2021, he was worth about $3.3 billion, built on the gap between what a metal box costs and what human indecision pays. Keep his name handy. What he did with all that boring box money is a story for another day. The machinery they don't show you now. The parts of the machine that stay off the billboard. Start with the pricing ladder. That $1 for your first month. Banner out front is a hook, not a price. Move-in rates are deliberately slashed. The national average move-in rate dropped almost 11% year-over-year recently. As operators fought for new tenants, and then the real number arrives a few months later, climbing 6 to 10% annually from there. The teaser gets your couch in the door. The Saturday with a truck problem keeps it there while the rate ratchets up. Then there's the number sellers don't want you to see, the difference between physical and economic occupancy. Physical occupancy is how many units have stuff in them. Economic occupancy is how much of the maximum possible rent is actually landing in the account. A facility can look 90% full and be quietly bleeding. Units rented at that dollar teaser rate, tenants 3 months delinquent, occupied spaces earning nothing. When you buy a facility, the seller shows you the physical number, glossy and high. The economic number is the one that pays your mortgage, and it's always the one you have to dig for. And then there's the lien. When a tenant stops paying, you don't chase them through eviction court like a landlord. After the legally required notices, you cut the lock and auction the entire contents of their unit to the highest bidder. Yes, that is the entire premise of the show Storage Wars. And yes, it's a real legal power you hold. It's a built-in collections department that turns dead weight into cash. But it is also the single most dangerous button in the business, and pressing it wrong is where owners get destroyed. In September 2024, the U.S. Department of Justice filed suit against Morningstar Storage, a North Carolina-based developer and operator of storage facilities and marinas. The allegation were that the company had enforced liens and auctioned off the belongings of 3 active duty service members at facilities in Florida and South Carolina without first getting the court orders that federal law requires. One of those tenants was an Air Force staff sergeant. She had told the facility she was on active duty. Then she deployed to Jordan. While she was overseas serving the country, Her unit was auctioned anyway, her military awards, her children's keepsakes, the contents of a life sold off to satisfy an unpaid balance. In at least one of these cases, a service member's entire unit went under the hammer for as little as $390. The law she was protected by is the Service Members Civil Relief Act. It says you cannot take an active duty members unit to sale without a specific court order, no exceptions, no, but they checked the wrong box. Morningstar paid $130,000 to settle and accepted a 4-year consent order dictating how it runs its auctions. And that statute has teeth well beyond one company. Since 2011, the DOJ has extracted over $481 million in relief for more than 147,000 service members under it. And a willful violation of the lien enforcement section isn't just civil, it can be charged as a misdemeanor carrying up to a year in jail. So the built-in collections department that looked like free money, one unverified tenant, one skipped court order, and your $390 auction becomes a 6-figure federal settlement with your name in the complaint. The lien is the most powerful tool you own and the fastest way to blow your own leg off. If you are still here, it means surely you will love our other videos. Please check out the channel and also subscribe to our channel. It will make sure every video will come to you first. The threat. Nobody warns you about. Set aside the legal landmines. There's a quieter killer, and it comes from the same fact that makes this business beautiful. Anyone can build a metal box. There's no patent on 4 walls and a roll-up door. So when a market gets hot, everyone builds at once. That's exactly what happened across the Sun Belt. In the last few years, Atlanta led the country with 2.4 million square feet of new storage in a single year. Phoenix close behind at 2.3 million, New York at 2.0 million. So much supply flooded in that street rents actually fell. The average 10 by 10 unit dropped almost 1% year over year, and national street rates declined for nearly 3 straight years, dragging same-store income negative across every major operator. And here's the number no first-time buyer wants to hear. A brand new facility takes 24 to 36 months to fill to a stable 85+%. That's 2 to 3 years of mortgage payments on a building earning a fraction of its potential. If 2 competitors break ground down the road during your lease-up and nothing stops them, your beautiful projected returns turn into a knife fight over $1 a month move-in specials. Markets with more than 10% of existing inventory under construction face revenue pressure for 18 to 36 months, and you have zero control over who pours a slab next to you, which quietly reveals what you are actually buying. It was never the metal box, it was the zoning. Cities hate approving new storage. It's ugly. It hires almost nobody. It generates little tax. Every permit a city rejects near your facility is a wall someone else paid the legal fees to build around your income. Buy in a market where they can't build more and the machine runs bulletproof. Buy in an open field where anyone can build and you're just early to your own funeral. Run it on a real deal. You buy a 30,000 square foot suburban facility, 250 units, all in for about 1.5 million, say 375,000 of your own cash, the rest borrowed. At 90% occupancy and $125 a month average, that's about $375,000 a year coming in. Operating expenses eat roughly 30%, no plumbing, no real staff. Remember leaving around $260,000 in net operating income. That's a margin north of 65%, in a world where a supermarket runs on low single digits. After the bank takes its slice of the mortgage, you're clearing somewhere around $160,000 a year in cash on $375,000 of cash invested, with the building appreciating underneath you and that 6 to 10% rent ladder climbing every year on tenants too busy to leave. And if you never want to touch a padlock, there's the version from your couch. The 3 biggest storage REITs already control roughly 15% of the market's square footage, and you can own a slice of thousands of facilities by buying the stock. Less money, 0 Saturdays, same machine underneath. Machine. The whole thing runs on a single sentence. Same rent as an apartment, half the cost, no toilets, and customers who'd rather pay you forever than spend one afternoon deciding what to throw away, which is the quiet joke at the center of the most boring building in America. You didn't buy a warehouse. You bought a toll booth on other people's inability to let go, And in this country, that road never empties.